Welcome back to Global Macro Pulse. It is Wednesday, February 11th, 2026. I'm looking at the screens this morning, and for the first time in a long time, the disconnect between the financial economy and the geopolitical reality, it feels almost violent.
It's stark. I mean, the numbers flashing on my terminal right now are,
Yeah.
frankly, difficult to overstate. We have to start in Tokyo.
We have to.
The Nikkei 225 has just shattered the glass ceiling. It hit an all-time record high of 58,015. But it's not just about the price level.
Yeah.
It's the volume. We're seeing a volume divergence in that market that we haven't seen since the recovery back in 2024. This is a vertical move.
I want to pause on that number for a second because I don't want anyone to just glaze over it. 58,000. For decades, the psychological ceiling for Japan was the 1989 bubble high, right? Roughly 39,000.
Right. And breaking 40K a few years ago felt like a monumental achievement.
It was a huge deal. But 58,000, that is a paradigm shift. Japan is officially, I think, undeniably exiting the lost decades. But here's the tension, and this is what's so jarring this morning. While Tokyo is partying, the U.S. is sitting on a geopolitical powder keg in the Strait of Hormuz, and we have a labor market here in the States that, quite frankly, it looks like a Potemkin village. It's a pretty facade, but there is rot underneath.
And the data supports that view, actually. It really does. We just got the January non-farm payrolls print this morning, 8:30 a.m. Eastern Time. The headline.
That's great.
Looks great.
Yeah.
Plus 130,000 jobs. A beat. But if you dig into the revisions for 2025, it is brutal.
It's unbelievable.
They revised the total job growth for the entire year of 2025 down to just 181,000 jobs.
Yeah.
That's it. For the whole year.
For an economy our size.
So we need to dissect the signal from the noise here, because the bond market is already reacting. The 10-year yield is back up to 4.20%.
Okay, so we aren't here to just read headlines. We are here to tell you how to position for what feels like a moment of rupture. Let's get into the liquidity cycle. Let's start with this Japanese renaissance. You mentioned the Nikkei at 58,000. Take us through the Tokyo session. What happened at the close?
So let's look at the close. 3:00 p.m. Japan Standard Time. The Nikkei ended the day up 2.3%. A huge move. But it's the composition of that rally that really matters.
It's internal.
The internals, exactly. SoftBank Group is the standout performer, up 10.6% on the day. I mean, that is a massive move for a conglomerate of that size. And we're seeing huge institutional inflows into ETFs.
Which ones?
DXJ specifically. That's the Wisdom Tree Japan Hedged Equity Fund. The volume there, it just suggests that this isn't retail speculation. This isn't just people chasing a headline.
No, this is institutional reallocation.
It is. And when I say volume divergence, let me just clarify what that means for people who don't stare at charts all day.
Yeah.
Typically, as a price trend gets older, volume starts to dry up, the buyers get exhausted.
Right.
Divergence here means the price is going up and the volume is accelerating. That means new money, big money, is chasing the move. It's a very powerful bullish signal.
And this is the Takaichi trade in full effect. We have to contextualize this because markets don't just move 2.3% in a day without some kind of major policy catalyst. Prime Minister Sanae Takaichi didn't just win an election. She secured a supermajority for the LDP and Ishin.
A mandate?
A real mandate. This is Abenomics 2.0, but on steroids. We need to understand why the market likes her so much. She's an aggressive fiscal hawk on general spending, but she believes in directed investment.
Yes, and that's the key difference.
The market is pricing in her specific platform, which is all about fiscal dominance. She's pushing these strategic technology R&D credits. We're talking up to 50% credits for AI and green energy.
Right, and we need to break down the mechanics of that credit because it's not just a standard tax write-off. This is important. Usually an R&D credit is just a deduction against your taxable income.
Right, it helps on the margins.
Exactly. The Takaichi proposal, from what the analysts are projecting, is a refundable credit against capital expenditure in these specific sectors. So let's use an example. If SoftBank spends $10 billion on NVIDIA chips to build a new data center in Osaka,
A very real possibility.
the government effectively hands them back $5 billion cash. That immediately fundamentally alters the return on invested capital models for every company in Japan. It makes projects that were just marginal suddenly incredibly profitable.
And that explains the SoftBank move right there, a 10% jump. If you are a company heavily invested in AI infrastructure and physical AI, a 50% tax credit is essentially a direct injection of equity onto your balance sheet.
It's a game changer.
It is pure industrial policy.
Right.
The government is picking winners, which, the market usually hates, unless, of course, the government is picking the companies the market already owns and wants to own more of.
Well, exactly. And the market is saying these are the right winners to pick for Japan's future.
But what's fascinating, technically, is the currency play. You have to watch the yen.
It's strengthening.
It is. It's trading around, 153.00 to 155.00 against the USD.
Which historically is a massive headwind for the Nikkei, right?
Yeah.
I mean, the old playbook was simple. Strong yen, weak exporters, Nikkei goes down. If Toyota sells a car in America for dollars and the yen gets stronger, those dollars are worth fewer yen when they put them home.
Exactly. That's the classic correlation we've all traded for 20 years. But that correlation is breaking down right in front of our eyes. We are seeing a structural re-rating of the entire market.
A total decoupling.
A total decoupling where the market just doesn't care about that currency drag because the domestic growth story, the industrial policy story, is so powerful. And the valuations are still reasonable. PE ratios are at, 16.2x?
Yeah, about 16.2. And you compare that to the 1989 bubble when the Nikkei was at 39,000?
Yeah.
PEs were at 60x?
60. It was absurd.
So this is an evaluation bubble. Not yet, anyway.
I want to push back just slightly on that valuation argument, though. While 16x isn't 60x, it is historically high for Japan, which for decades has traded at a discount because of, poor corporate governance.
The Japan discount, sure.
The bet here, the real bet, is that the governance reforms are finally real, that forcing companies to unlock value, to buy back shares, to increase dividends, that this time it's sticking.
I think that's right. But to your point about the yen, this decoupling suggests that global investors are buying Japan for Japan, not just as a proxy for a weak currency trade.
That's the whole narrative. It's the safe haven with growth story. Think about the alternative capital flows in Asia right now. You have China, which we'll get to later, stuck in a deflationary death spiral.
There's nowhere else for the money to go in the region.
Capital is fleeing China, and it needs a home. And it's parking in Tokyo. We're seeing a massive Japan instead of China trade. The productivity tax credits, the 7% ones, are real. This isn't just speculative froth. It's a fundamental rotation of global capital. Japan is becoming the adult in the room in Asia.
It is. And the technicals, they confirm it. Look, the momentum indicators on the Nikkei, things like RSI, they are overbought, sure. But in a breakout scenario like this, overbought can stay overbought for a very long time. The key support level has now moved all the way up to 56,000. As long as we hold that, this trend is intact.
And where is that capital coming from? You mentioned it's not just from China.
No, it's not. It's coming from the U.S. It's coming from Europe. Money managers are looking at their allocations and saying, why am I overweight U.S. tech at these valuations when I can get this growth story in Japan at 16 times earnings?
Which is the perfect segue. Let's pivot to the other side of the Pacific. Washington, D.C., 8:30 a.m. Eastern Time this morning. The Bureau of Labor Statistics drops the January jobs report. Break it down for us.
So the headline number, as we said, was a beat. 130,000 jobs added versus consensus expectations of around 70,000. And the unemployment rate ticked down from 4.4% to 4.3%. On the surface, if you're an algorithm just trading headlines, you buy the dollar, you sell bonds.
And that's exactly what happened for the first few minutes.
That's what happened initially. But any human, any analyst looking at this report for more than 5 seconds should be deeply, deeply concerned.
Look under the hood. This is where those macro headwinds become crystal clear. You mentioned that 2025 revision earlier. I really want to unpack that because the number is just shocking.
It's catastrophic. The BLS benchmark revisions reduced the number of jobs created last year, all of 2025, to just 181,000. Let that sink in.
Less than what was reported for a single month sometime.
Less than half of what was previously reported. It implies that for most of 2025, the U.S. economy was essentially stalling, completely masked by seasonal adjustments and, importantly, the birth-death models that were just far too optimistic.
We have to explain that birth-death model because it sounds like a demographic statistic, but it's actually a statistical trap in this labor data.
Right. So the BLS can't count every single new business opening or closing in real time. It's impossible. So they use a statistical model, the birth-death model, to estimate how many jobs are being created by new business formation.
It's a plug.
It's a plug. And the problem is, this model is cyclical. It assumes that the rate of new business formation is constant based on past trends. So when the economy starts to turn down, when fewer businesses are being born and more are dying, the model just keeps pumping out these ghost jobs, assuming the good times are still rolling.
Yeah.
It always, always overestimates at the top of the economic cycle.
So all year in 2025, we were told the economy was adding 150K, 200K jobs a month. The market traded on that narrative. The Fed set interest rates based on that narrative. And now, a year later, the BLS says, oops, actually, we barely created any jobs at all. We were looking at a labor market that has completely stalled. It's a paper tiger.
It is. And when you look at where the jobs are actually coming from in this January report, it gets even more concerning. This is not broad-based growth.
Not at all.
No, the sector analysis is stark. 60% of the gains in January were in two sectors. Healthcare, that was plus 82,000 jobs, and social assistance, plus 42,000. These are sectors that are largely insensitive to interest rates and, frankly, often government-funded.
It's demographics.
It's demographics. It's the aging population demanding care, which is necessary, but it's not a sign of economic dynamism. It's a sign of an aging society. Construction added 33,000 jobs, which looks good on paper, but analysts are pointing out this is almost entirely specialized trade contractors building data centers for AI.
Right, so you have government-subsidized healthcare and AI capex. That's it. That's the entire growth story of the United States right now.
Exactly. And meanwhile, look at the cyclical engines of the economy. Financials lost 22,000 jobs. That is a massive red flag. Banks hire when they expect deal flow and lending to increase. If they are firing people, they expect a contraction.
A serious contraction.
And manufacturing is flat. It has lost 80,000 jobs since the administration changed. We're just not seeing the manufacturing renaissance showing up in the payrolls data. It's not there.
This is a classic K-shaped divergence, the wealth effect. Stanks at record highs, home prices holding up. That's propping up the top 10%. But the real economy, the transactional economy, is shedding full-time, high-paying jobs.
And there is a data quality issue here, too, that we can't ignore. The response rate to the household survey, which is where the unemployment rate comes from, was only 64.3% this month because of severe winter weather across the country.
That's historically low.
Historically low. Usually you want that number in the 80s or 90s. When the sample size drops that low, the volatility of the data just skyrockets. The error bars on this 4.3% unemployment rate are massive. We could easily be at 4.5% or 4.6% in reality. The market is trading on a number that has a very, very low confidence interval.
Which makes the bond market's reaction even more dangerous and, frankly, confusing.
The bond market sniffed this out eventually, but that knee-jerk reaction was to sell. Yields on the 10-year spiked to 4.28%. Why? Because that headline number, that 130K, gives the Fed cover to hold rates higher for longer.
Right. They can't cut into a headline beat.
Even if the data is low quality, the Fed rarely, if ever, cuts into a headline beat. So the probability of a March rate cut has completely collapsed. It's down to 6%. The market is now looking at June, maybe even later, for the first move.
And this brings us to the elephant in the room, Kevin Warsh, Trump's nominee for Fed chair. This nomination is changing the calculus for the entire yield curve. We have to profile him for a minute because he is not Jerome Powell.
No, he's definitely not. For those who don't remember, Kevin Warsh is a former Fed governor. He served from 2006 to 2011. He was known for being the youngest governor in history at the time he was appointed.
And he was a hawk back then.
A huge hawk. He was very, very critical of Bernanke's quantitative easing programs. He was worried about inflation even when the economy was collapsing during the great financial crisis.
But that was 2010 Warsh. The 2026 version of Kevin Warsh seems to be a very different animal.
And that is what is causing so much confusion in the price action. The market is trying to figure out which Warsh we're going to get. Recently, he's been writing these op-eds in the Wall Street Journal, and he's aligning with Trump's call for lower interest rates. But his justification is really interesting.
It's the productivity argument.
It's the productivity argument. He's citing supply-side optimism. He believes that AI is going to unleash such a massive wave of productivity that the Fed can run the economy hot without causing inflation.
It's a total regime change. We are moving from a data-dependent Fed the Powell era of we'll wait for the lagging indicators to what could be a strategic Fed. If Warsh takes the chair in June, you should expect a pivot toward accommodating the Treasury's massive need to fund the deficit.
And this is where the concept of fiscal dominance comes in. Can you explain that for the listeners? It's a critical concept right now.
Absolutely. Fiscal dominance is the nightmare scenario for a central bank. It's a situation where the government's debt and deficit are so enormous that the central bank effectively loses its independence.
It becomes a subsidiary of the Treasury.
Exactly. The Fed can no longer set interest rates to manage its dual mandate of inflation and employment. It has to set rates low enough to keep the government solvent. If rates stay at 5%, the interest expense on the U.S. debt will consume the entire federal budget. It's unsustainable. So the Fed is forced to print money to buy bonds. essentially monetizing the debt regardless of what inflation is doing.
And that is the terrifying part for bondholders. The deficit is projected at, what, $1.9 trillion for 2026?
1.9 trillion, and the supply of new bonds coming online is just relentless. So if the Fed pivots to accommodation not because inflation is low, but because the Treasury needs to sell bonds, that is fiscal dominance. It means the dollar takes the hit to save the bond market.
The bond vigilantes are watching this very, very closely. That is why you're seeing the 10-year yield at 4.28%, even with a fundamentally weak underlying economy. Normally, if the labor market was this weak, yields would be crashing down to 3.5%.
They would be collapsing.
But they aren't. Investors are demanding a premium, an inflation risk premium, for the risk that the Fed lets inflation run hot to inflate away the debt. Without some form of yield curve control or a massive new liquidity injection, 4.20% might just be a pit stop on the way to 4.50% or even higher.
And let's be clear about what that means for stocks. If we break 4.25% on the 10-year, the technical damage to the equity market could be significant. The entire valuation model breaks down.
The equity risk premium evaporates. It's that simple. The ERP is the extra return you expect to get from taking the risk of owning stocks over holding risk-free Treasury bonds. If bonds pay you 4.5% risk-free, why would you buy the S&P 500 at 22 times earnings? That's an earnings yield of about 4.5%. There's no incentive to take the risk.
And that's when you get a major correction.
That's when you get a correction.
Okay, let's talk about the other risk premium that is creeping back into the market, the war premium. We have to talk about the Middle East. Geopolitics is back in the driver's seat for the entire commodities complex.
It absolutely is. We are looking at credible reports confirming the Pentagon is prepping a second aircraft carrier strike group for deployment to the Middle East. This is a significant escalation of force posture. You don't move a carrier group unless you are sending a very serious message or preparing for a kinetic event.
And you have Netanyahu in D.C. right now, pressing the Trump administration on Iran. The rhetoric is heating up significantly. They are talking about the nuclear program, the ballistic missiles, and the market reaction is immediate and visceral.
Look at WTI crude. It's pushing $65 a barrel. Brent is near $70. Now, to the average listener, $65 oil doesn't sound like a crisis. We've seen much higher.
Right.
But you have to look at the context. We just got the EIA data yesterday showing U.S. crude inventories surged by 8.5 million barrels.
That is a massive build. In a normal market, an 8.5 million barrel build would crash the price by $3 or $4 in a day. It screams that supply is outstripping demand.
Exactly. Technically, that inventory number should crush the price of oil. But the price is rising. That disconnect, that gap, is the war premium being priced in real time. The market is completely ignoring the physical surplus because of the geopolitical floor under the price.
Traders are looking at that inventory sitting in Cushing, Oklahoma, and they're saying, that's great, but if the Strait of Hormuz closes, none of that oil matters to the global market.
Because the Strait of Hormuz is in play. Roughly 20% of the entire world's daily oil consumption passes through that single choke point. If negotiations on the nuclear program fail, and Iran is publicly saying they will not negotiate on their missile program, we're looking at a supply shock that no inventory build can fix.
You can have all the oil in the world in Cushing, Oklahoma, but if the tankers can't get through Hormuz to supply Asia and Europe, the global price spikes. It's a logistical nightmare.
And traders are pricing in that tail risk. The volatility skew in the oil options market is showing a huge amount of demand for upside calls.
Yeah.
People are hedging against a spike to $80 or $90 a barrel. But I want to pivot to what I think is the bigger story here. The real systemic risk indicator isn't oil, it's gold.
I agree completely.
Gold is trading at $5,070, just off the all-time record of $5,118.
This is the story of the day for me. Gold typically has an inverse relationship with two things, the U.S. dollar and real yields. If the dollar is strong, gold is more expensive for foreign buyers, so demand should fall. If yields are high, gold, which pays no interest, becomes less attractive, so demand should fall.
And today?
Today, we have a stronger dollar. The DXY is at 96.99, and we have higher yields. Gold should be down hundreds of dollars. It's not. It's buying every single dip.
That divergence is just screaming that this is not a trade about interest rates. This is not a trade about the Fed. This is a trade about sovereignty.
That is the systemic risk bid. This is not retail investors buying gold coins. This is central banks. Specifically, sovereign actors who have been sanctioned by the West, or those who fear they might be next, are systematically dumping U.S. treasuries and buying physical gold.
It's a move away from the weaponized dollar.
Completely. We are seeing a polycurrency world emerging before our eyes. If you are China or Saudi Arabia or Brazil and you see the U.S. seizing Russian central bank assets, you realize that your treasury bonds are not risk-free assets. They are political hostages. So you buy gold. Gold has no counterparty risk. It's nobody's liability.
And we just saw reports that Chinese regulators are actively advising their commercial banks to reduce holdings of U.S. treasuries. That aligns perfectly with the price action we are seeing in gold. It is a slow-moving, but massive, rotation out of fiat debt and into hard assets. It's a very defensive, almost bunkers-down mentality from global institutions.
Speaking of China, let's look at Beijing. China Standard Time. The data coming out of there is, concerning is putting it mildly. We talk about the U.S. having a Potemkin economy, but China is facing something potentially much worse.
It's outright deflation. CPI is at 0.2%. They barely avoided a negative print, but PPI, the Producer Price Index, has now been negative for 40 consecutive months.
40 months.
Think about that. For more than 3 years, prices at the factory gate in China have been falling. That is a factory sector that has absolutely no pricing power. They're just slashing prices to move inventory because there is zero domestic demand.
And this is China Shock 2.0. In the early 2000s, China exported cheap goods and the West got cheap TVs and low inflation. It was, arguably, a net benefit for the Western consumer, even if it hurt manufacturing jobs.
This is different.
This is different. Now, they are exporting desperation. They are flooding global markets with low-cost goods, EVs, solar panels, steel, legacy chips, because their domestic consumption engine is dead. They built all this capacity for a property boom that is now over, and they have nobody to sell it to at home.
But look at their trade surplus. It's $1.2 trillion, a record. So they are producing, they are not consuming, and they are dumping the excess onto the rest of the world. This is mechanically forcing deflation onto the rest of the world's manufacturing sector. If China is willing to sell steel at a 20% loss just to keep the furnace running and keep people employed.
U.S. steel and European steelmakers cannot compete. It's impossible. And that is what is triggering this massive protectionist backlash. Which brings us to the moment of rupture in North America. It's not just about China anymore. Look at the U.S.-Canada relationship.
Fracturing.
Trump threatening 50% tariffs on Canadian aircraft and decertifying the Bombardier Global Express. This is our closest ally.
That is a massive, massive disruption. We're talking about the supply chains for American Airlines, for Delta, for all the regional carriers. They rely on these jets, the Global Express for business travel, the C-Series, which is now the Airbus A220. These are integral parts of the U.S. aviation system. The market has not fully priced in what happens if that supply chain just snaps overnight.
It signals the end of the liberal international order. It really does. When your closest ally, your neighbor, is facing 50% tariffs and regulatory warfare, the macro headwinds are reaching gale force. And you're seeing Canada already looking for a plan B. They are actively trying to diversify their trade away from the U.S.
We saw the Canadian Prime Minister Mark Carney explicitly use this phrase, this moment of rupture, at a conference last week. He's talking about a world where the U.S. is no longer the reliable anchor of the global system. For a data analyst, that means increased volatility in FX pairs like USD-CAD, which has been relatively sleepy for years. We could see a massive repricing there. If Canada pivots to trade more with Europe or Asia, the flow of dollars and loonies changes structurally.
Okay, so let's bring it all together, the so what question. How do we position portfolios for this? We have a Japanese boom, a U.S. labor market illusion, a confused Fed, and geopolitical firestorms on multiple fronts.
Well, from a pure asset allocation perspective, the momentum is clearly in Japan. The Nikkei has the volume, it has the policy support, and it has the earnings growth. The technicals on SoftBank and Toyota still look incredibly robust. SoftBank breaking out on that AI volume is a signal you have to follow. I would also look at the Japanese banks, as they will benefit massively from this reflation trade.
I agree. Japan is it's the only major developed market with a clear pro-growth fiscal and monetary alignment right now. In the U.S., you have to be careful.
Very, very careful. This AI sugar rush is narrowing market breadth to a dangerous degree. The FactSet data shows that all the S&P 500 earnings growth is concentrated in a handful of tech names. The S&P itself is trading at 6,941, but if you strip out the top 7 names, the valuation of the other 493 stocks looks very, very different.
It's a weak foundation.
It is. And if yields keep rising, the valuation compression on the broad index is going to be painful.
So you have to watch that 200-day moving average on the 10-year yield.
That's the key level. If we break 4.25% on the 10-year, the equity risk premium, as we discussed, essentially evaporates. That is the danger zone for all risk assets. At that point, you want to be holding cash or short-duration treasuries, waiting for a better entry point.
And you have to keep a hedge in gold. I know it feels expensive, but with the axis of resistance active, with U.S. fiscal dominance unchecked, and with the long-term trend being the debasement of fiat currency, you need that insurance policy in your portfolio.
Absolutely. Gold at $5,000 feels expensive. But in real terms, if the dollar is being debased to fund a $1.9 trillion deficit, it might still be cheap. It's all relative.
My final thought is on volatility. The VIX is trading at 16.92. It's compressing. But when you look at the geopolitical map, that feels like the calm before the storm. Usually when the VIX is this low while the world is this chaotic, it's a sign that the market is complacent. And complacency is expensive when it breaks.
It does. The discrepancy between the VIX and the geopolitical reality is as wide as I have ever seen it. Buying volatility here, whether that's puts on the S&P or calls on the VIX, is a cheap hedge against this rupture we've been talking about.
We are living in a polycentric world now. The old rules of globalization are dead. You have to adjust your portfolios accordingly. Stay liquid and stay alert.
And watch those key resistance levels.
This is Global Macro Pulse.
Disclaimer: content is for informational purposes only and is not financial advice.